lectures. So I will try my best to make you engaged in this session. Actually, after having lunch and to sit for another lecture, it is very tedious and cumbersome. So to that extent, I will like to apologize, but I will try to make it more interactive and interesting. So the methodology can be like, if you have any question or doubt, you can put it in the chat box and then we can take it up. So simultaneously, I will be also referring to the chat box or the text box. And if you have any question, I will try to answer it, or else we can take up at the last. And so, as what Dr. Vishal has mentioned, that I will be speaking on financial issues in social enterprise management. I also, hope very positively that you all must have enjoyed your lectures of last previous 2 days, and the same will continue in coming days also. So, in continuation to that, I'm taking this opportunity to thank the management or the organizing team of this conference for giving me this opportunity to take this lecture here. So, good afternoon to you all the participants who are, from different parts of the. See, coordinator has given his, okay. So thanks from my side also, and you all are from different parts of the country. So I also welcome you in this FDP, and the financial issues of social enterprise management. I will also like to share a presentation which I made on this occasion. When we talk of financial issues, there are the presentation or the deliberation I have divided into two components. The first component is catering to the basics of social enterprise management. When we talk of social enterprise management, we must understand the social enterprises, then financial management of a social enterprise, and of course, the overall portion of it. And then the intricacies of financial issues, the intricacies of financial management, which we divide into three components. The first one is financing, then investment, and then management of earnings. So when we talk of these three issues, they are more intricate to the financing part of a social enterprise. And so that I will be covering in the latter portion. But first of all, let us have some kind of overview over the social enterprise. When we talk of the social enterprise nowadays, it has become with a great force, a great momentum, because the government, they have failed to do their job, and it has created a big vacuum, and these enterprises, they have been raised to fill those vacuums. And of course, what I think there is a disturbance from side of one participant. uh, Yes, sir. Thank you, sir. Thank you. Thanks a lot. So, when we talk of social enterprise, the definition is not universal. Every organization or every country, they have given contextual definition of social enterprise. Of course, it's a business propagation. Without business, it is not wise to talk of social enterprise. So, business has to be there. But how it is different from other normal course of business structure or other legal forms of doing business, so that we need to understand very thoroughly. Like when we talk of a company form of business, a company form of business is primarily from the viewpoint of shareholders' wealth maximization. When we talk of the wealth of shareholder, we mean to understand ultimately the year by year the profit which is distributed to shareholders, that has to be handed over to the stakeholders, and that has to be maximized. So to that extent, we can say that the objective of a private limited company is for the maximization of wealth of shareholder. But in case of social enterprise, there is a little bit difference when we talk of wealth or a profit. Should we do everything for social cause? Yes, social cause is there as the underlying objective of a social enterprise, but also on other side, other aspect of the coin is profit. So two aspects of the coin of social enterprise. One is the societal objective, the issues which are unaddressed, and then the second one is the profit. So self-sustainable kind of social objective, also social fulfillment, environmental fulfillment, that leads to the basics of social enterprise. And financial issues are very important. Normally people say that for social enterprise the objective should not be the profit. But okay, let us go by that assumption that profit is not the objective. So if profit is not the objective, then we must subsidize the profit. The objective should not be earn profit. Or even if the profit is being generated, it has not to be distributed in the form of dividend. Now, the point is here that if operating revenues are to be discounted, then what will happen to operating costs? No, cost cannot be discounted. The raw materials price, they cannot be discounted. You can get charity, you can do charity in terms of distribution of your not distributing profit, but we cannot do charity in terms of cost, in terms of operating cost. If like most of the social enterprises, they are involved in service sector. If we take the data, 70 to 80% they are involved in services sector, and very few are in manufacturing. But even though which are involved in manufacturing, for those kinds of firm, what happens, the costs are involved. The biggest issue is working capital. And if we don't talk of profit, or even if profit is there, but consideration is that we should not return the investors money as what is being thought of, then it will become a charity. So there is a difference between social enterprise and a normal enterprise. Okay. And the other form, that is charitable or an NGO. So here we are talking of social enterprise. Profit is an objective, but core is the social fulfillment, the social causes for which the business is being done. Of course, the profit will not be distributed. If we talk of from the perspective of the lender, those who provide money to the social enterprise for doing their business, of course they want money. But if they want money, can we say that they are participating in a social enterprise? Yes, we can say, like if market rate of interest is 10%, they can say, okay, give us return of 5%. So if social enterprise will not be self-sustaining, if it is going to eat away all the capital, and capital is not formed or generated further on, then how come that is going to be rotated, or a vicious cycle can be created? So for creation of vicious cycle, or this capital is to be multiplied for the benefit of more and more social enterprises, it is important that capital has to be returned, whether it is to the lender, or it is to the in the form of a bond, or it is in the form of a social equity. So it is very important that capital has to be returned back. Now the issue is that what should be the legal status of any social enterprise? It can take form of a PLC, private limited company, or it can take form, because profit or not for profit, both can be a social enterprise. So an NGO can be there, sole proprietorship firm can be there, then partnership firm can be there, then we have a section 8 company can be there, or LLP can be limited liability partnership, or limited liability company can be there. So these are all legal structures which can be followed for any startup or for any social enterprise. But the objective has to be set forth, and the objective is that the profit has to be earned. It is social business. It is social business, and profit has not to be distributed in the form of a dividend. Profit is not to be distributed in the form of dividend. We all know that in the case of equity, if any venture capitalist is coming, or if any angel investor is coming and taking participation in an entrepreneurial venture, now it wants return. But in case of social entrepreneurs, social enterprise, this is one of the biggest challenge. In search of financing sources, financing is not easily available, and that too for startup. When we talk of a startup or when we talk of a new entrepreneurial venture in social business, it is hard to find finances. In fact, it is even hard to find finances for even normal profit seeking entities, what to talk of social business. So financing is an issue. Financing is a big issue for that. And when we talk of social business, yes, of course, and when we add the self-sustainability concept in social entrepreneurship, we get social enterprise. So the firm has to be self-sustainable. The firm must have the capability to earn profit, and of course, the profit will not be distributed as in the form of dividend to the equity shareholders or the debt holders or the lenders. It can be retained, and now what might be the usage of that profit by the enterprise. It can use it as a reserves. It can use it to pay to its beneficiaries or the staff, or it can use it for a reinvestment purpose. It can use it for expansion. It can use it for merging itself with any other company or acquiring a new entity. That is wholehearted expansion. So these are the issues which are the applications of the profit by a social enterprise. And if it is distributed as a dividend to the equity shareholders, then there is an issue to call it as a social enterprise. So we should understand the crux of social enterprise, and lots of tax incentives are also being given to these social enterprises. You may have certain doubts that why these enterprises they get a lot of tax incentives. It can be a trust, or it can be every other form of business, societal form of business. And they get a lot of tax breaks, a lot of tax incentives. Now, what is the need of these social enterprises? The need is that government has failed in its primary duty to provide sanitation services, facility, literacy, then establishing equality in the society, and many more issues. So for that purpose, initially it began with that the corporates, it invited the corporates to participate in this. But to what extent these corporates have been successful through their that very buzzword which we call as corporate social responsibility, that out of their profit, some portion they have to spend on the well-being on the upliftment of the nearby society, of which resources it is using. Simultaneously, now after certain period of time, government thought that okay, this is not proving to be sufficient. So why not offering these tax benefits also to some social businesses? And tax is a very important factor. I will prove it later on that with help of the capital structure of these social enterprises, that how tax is a very determining factor, that many persons they are attracted towards these social businesses because they get a lot of tax breaks. Either you are establishing an educational institution or some kind of some kind of training programs, skill development programs, you get a lot of tax incentives. So that is a social enterprise. And because ultimately government, it is the responsibility of the government, but government has failed to address that. So it must give some kind of tax incentive those who are fulfilling these causes and doing the responsibility. So these are the issues which we must understand before going for. So they're talking of the financial issues of social enterprise. Now, what are the specific objectives of a social enterprise when we talk of financial issues? Like one such issue is it gives a lot of job or employment opportunities. Now I can open a some kind of what we call Bandara, or some kind of langar, where I can those who are destitute, those who cannot have their own food, they can come there. So that is also a social enterprise, but it also generates employment, large scale mass. It also generates employment. Then improving health and well-being. So that may be the other objective of a social enterprise, the use of finances. That's why there is less return, and because of less return, there is less propensity of venture capitalists, social venture capitalists, or angel investors to come and participate in social businesses. Then addressing the social exclusion, we talk of equality in the society. So those who are socially excluded, to address their issues, we need social enterprises. Then supporting agricultural and allied activities, then empowering and uplifting women, then promoting education, because still 30% of our population is illiterate. So a lot of programs are going on, and largely there is an excuse by most of the educational institutions that they are the those who are passed out, or those who are coming out of the schools, they are unemployable. So how to make them employable? So skill development program, then supporting other social enterprises and organizations, then then help age India kind of thing. So we have all these social enterprising activities for which we need finances. And these activities are so important that we must understand that the return might get suffered, the return, because they may consume capital. But when we talk of the business model or some innovative model which can even give the return on these kinds of investment activities, that is going to be a social enterprising business model. Now I can give you certain models, certain examples of social enterprise businesses where the people, they can invest and they can get some profit out of it. Like skill development is one such sector. Then agriculture is there, fisheries, dairy, then financial services. Lot of we talk of financial inclusion. So for that purpose, a lot of financial services are offered. Then healthcare is then, food and nutrition is there. Then solid waste management and sanitation is there. Affordable housing is there. So these are the issues which can be addressed when we talk of social enterprises and the sectors where it can be done, and the need of finances. And then we can talk of the profit or surpluses which are generated by these social enterprises. Like as I have already explained earlier, that it can use the profit, because the profit, if it is being distributed as dividend to its social equity holders, then we cannot term it as a social enterprise. So that is a thin line of difference between a normal entrepreneurial activity or an enterprise and a social enterprise. So it can be like in the case of growth and development activities, then rewards to staff and beneficiaries, cross subsidizing, then creation of its own reserves, then funding third party activities and so on, which can expand the enterprise base. But the barriers are also there, the obstructions are also there. One such obstruction is the capital is whether it is in the form of equity capital or debt capital, because there is a resource crunch of financial resources are in dire need by these social enterprises, because those who are the investors, they know, even if a kind of social bond is there, if a normal bond carries 10% rate of interest, the social bond carries only half of that, 5% rate of interest. They know that half of the amount will go in the social enterprise, and the only return which they are going to get is half. So from day one, they know that there is a problem in getting the return on their investment. So there is a resource crunch, whether it is from now equity can be there, but we cannot invite angel investors or venture capitalists, because then they will demand the share in the equity shares, and they also want return. And when they want return from us, from a social enterprise, then there is a big issue in that. Then we cannot categorize that as social enterprise. Then there is a funding issue is also there. Since this is not a charitable organization, charity is also being if we talk from the perspective of funding activities, like the grants from different institutions are being received. It can be in kind, or it can be in cash, or if it is in the form of equipments like or donations, it can be there. Then grants are also received from the government, then in the form of contracts from the government. So these may be, these may be one way of solving the funding problem of a social entrepreneur, a social enterprise. But when we talk of financing, sought by social enterprise, there is a difference. Funding sought by social enterprise and financing sought by social enterprise. So there is a difference between fund and finance. Fund and finance. So fund is more or less related with not a long-term requirement for a business. Fund, like, you don't confuse this fund with International Monetary Fund. Here we are talking from the perspective of working capital, to the extent of working capital, because working capital means the capital which is required by a business to run its normal operation for 1 year. So funding requirement has also there, but how they are going to be managed, a short-term loan from a business, from a bank, or from a commercial bank, or through the sources which I have just narrated, like grants, it can be there, or cash donations, or equipment funding can be there. Donations can be there, because all these things, they get tax benefit, to the extent of the amount which has been given as the donation, or in the form of the grant, the party gets the tax benefit. Then grants from the government, the contracts, many times the government offer funds to these agencies, to these enterprises, in the form of contracts or projects. So they get a lot of funds, but that is related to the requirement of working capital, primarily to meet out their current asset and current liability requirement. But when we talk of financing financial issues, so for that purpose, we should understand the difference between financing and financial. Financing is one-way traffic. We get, just like in the old economy era, we were having mammoth institutions. We were having clear-cut demarcation between capital market and money market. Capital market is the market meant for long-term lending, borrowing of funds, and money market is meant for short-term lending and borrowing of funds. So earlier, capital market, the institutions which were of capital market, they were exclusively meant for capital market, and similarly, it was true for money market institutions. So there was no hybrid kind of situation, hybrid kind of markets. That is, the capital market institutions can come and play in money market, and vice versa. But after when we opened up our economy in 1991, when we faced a lot of crisis in terms of inflation, interest rate, fiscal deficit, a lot of financial issues they were impending in the initial part of 1990s and latter portion of 1980s. So that time government stopped giving budgetary support. So and before that, most of our public sector units, they were all social enterprises, because their objective was not to give dividend to the government. Their objective was societal, to provide large scale employment, to use the natural resources which are there, keeping into the pollution check and all carbon norms which are there, which has to be followed. So not blind materialistic kind of society, or blind material kind of production or business they were adopting. So their business model was very much societal, because we were following a socialist pattern of our economy. But ultimately, that also resulted, if that was that was required for our economy in the initial part of our independence, from 1947 to till 1980s, when our coal mines were nationalized, or when our banks were nationalized in 1980s. They were the demand of the time, because it was only responsibility of only the government to do business, as well as to create an environment where private businesses, they can come and flourish. So in initial portion of our independence for 30-40 years, there was lack of confidence in private sector. So it was the responsibility of the government to come and do business, as well as do societal, some kind of societal follow societal norms, so that it can be beneficial to the society at large and private. That's why government was manufacturing scooters, government was manufacturing cars, everything was government was maintaining hotels. But later on, these things they created, what we call malfunctioning or inefficiencies in the system of government, and ultimately government has to forbid those sectors of the economy where the private sectors can operate and they can play well. And ultimately, the societal objective the government has to leave behind. And ultimately, these corporations, these companies, these mammoth public sector companies, they have to come down onto the basics, that is earn profit. There was, that's why the strategic sale of public sector units came, and we call that as disinvestment. Disinvestment started taking place. We all know the case of Maruti Suzuki. We all know the cases of ONGC or many public sector units, even Coal India Limited. So many companies, they have been divested in last 20 or 25 years. So when we talk of the resource crunch, so ultimately the government has to also liberalize the financial markets. The money market institutions, they have been liberalized, and they were asked to also operate in capital markets. So what happened, that banks, commercial banks, those who were earlier dealing only in money market, they changed their character and they have become the financing institution also. Earlier they were financial. Financial means two-way traffic, means you are having your own source of getting funds, like deposits, small deposits, large deposits, and then you are using those funds for disbursement of funds. So you are also lending them and you are also accepting deposits. So all commercial banks, they are financial institutions. When we talk of financing, earlier it was IDBI or ICICI, but they have changed their character. Now they have become all financial institutions because government has stopped providing budgetary support, and whenever they used to operate, and they most of the times every year when they used to suffer losses, like also Unit Trust of India was also there, government used to provide a lot of budgetary support, and budgetary support, it comes out of taxpayers' money. So that government has to stop under the international pressures because it has to liberalize its economy. So the institutions, they started operating in each other's periphery, in each other's domain. So now commercial banks, they have become institutions of capital market. Certain capital market institutions, they have become institution of money market. Like ICICI became ICICI Bank, then IDBI became IDBI Bank. So they are the biggest provider of capital, not only in the normal enterprises, but also in social enterprises. But the issue is the return. They can provide the capital in the form of CSR, in the form of, apart from CSR, they can also provide direct financing activities in the name of working capital to these agencies. So to these social enterprises. So let us see the financing sought by social enterprises. Like one such source is what we call equity or equity-like investment. Equity or equity-like, if it is a, if social enterprise is like a PLC, private limited company, and we all know that the total number of owners, they cannot be more than 200. So if the structure is of social, if it is a PLC, private limited company, in that case, the equity can be issued for subscription of by not more than 200 persons. But every form of business is having its own pros and cons. So then we have capital grant. Capital grant can be received from different institutions. Then commercial loans. Commercial loans can also be taken from the market through bonds or through debentures, which can be issued by any enterprise in the market at a subsidized rate. Because if it is a social enterprise, then the lender also knows that it is not going to get the market rate of interest. Then concessional loan, that is loans which are below the market rate. So then the problem is that here, these are the instruments which can be used by social enterprises, but the constraints to funding and finance faced by social enterprises are many. Like access to investors is low due to limited network. These social enterprises, they may be new, and normally only those they are successful which are having a long past tradition of operating in the market. So that is an issue. and that is due to limited network, they may have access to low investor base. Then also there is another problem is limited supply of capital. Now, capital, we mean to say that amount invested by either the partners or the equity holders or the lenders in the business. There is a limited supply of that we should accept it. Unless and until there is self-sustainable model, no one is going to invest in this model. Okay, and if investment will be there, we don't call it as investment, that is charity. Nobody wants the return on it. But social enterprise, it wants it is social business, it is a business. So let us talk, the core is societal benefit, but the ultimately profit surrounds that core benefit. So we must understand the importance of profit in a social enterprise. That we will talk specifically in the latter context. Then revenue to equity investors, that is another constraint. Revenue means any equity investor which wants return. When we take example of two kinds of business structure, normal and social enterprise. Now, please pardon me that every time I am saying normal business, normal enterprise, and social enterprise, because the share of social enterprise, if you take it in a total business sphere, it is not even 1%. So that is why we can talk of from the perspective of 99%, but here we are talking of from the viewpoint of from the context of only 1%. So let us set the context first. And this is from the equity shareholders perspective, and it is very, very difficult, to convince equity holders to invest their money in a social business, because in normal enterprises their gain is twofold. So their capital gets appreciated. Apart from that, they get a lot of return in the name of dividend. But here, in case of social business, it is difficult to expect appreciation in the capital, because if you are not getting dividend, then it is hard to expect appreciation of the capital. So because both are vice versa. If dividend is not to be distributed to equity shareholder, because here the objective is societal benefit, so the dividend will be the earnings will be distributed in the form of, it will not be distributed, it will be reinvested. It will be, as I have explained earlier, that it can be reinvested or it can be used for some kind of payment to beneficiaries, but not payment to the equity shareholder. Because if dividend is to be paid to equity shareholder, then it will be a normal enterprise, it will not be a social enterprise. So this is one of the great limitation of a social enterprise constraint, that revenue for equity investors, it is limited. And then bank loans, for normal bank loans, when we talk of for normal bank loan, the market rate of interest it operates. Or even if you talk from the low risk perspective, then the RBI flexi bonds, the base rate is followed. But yeah, when we talk of social enterprises, even that gets harmed. You cannot charge market rate of interest from a social enterprise, because it is not generating that much of profit. And even if it is doing normal business, it is not in the position of giving return in the name of interest. Although we know that the social enterprise, it gets benefit on two counts. One such benefit is the tax break on its normal operations, and second one is the interest deductible, the tax deductibility of the interest payment onto the borrowed amount. So that social enterprises know. But since the objective is not profit, so interest cannot be the market rate of interest. So there is a limitation. And then it is also furthered by, this is also intensified by limited track or profitability record. Most of the social enterprises, if you talk of from the profitability perspective, profit means the surplus from the point of view of an NGO, and profit means all the balance amount which we get after paying all the expenses, whether direct or indirect. So there is a limited track record of profit earning capability by social enterprises. You talk of any social enterprise, either they are new or even if they will be old, there is a limited profit track record. So business, and why this is so, because business model is not appealing, or it is not refined, because the activities in which they are involved, it is not for charging high prices, but it is for right prices. You have to charge right prices for the goods or products which you are offering. Because for a social enterprise, you cannot, just go on selling refrigerator to Eskimos. You have to find out the need for it. You have to conduct a survey that whether there is a market for it or not, and if market will be there, then what will be our end, what will happen to our end objective, whether we are going to meet our end objective or not. So there is a limited, appeal or refining of business models. Then, of course, regulatory constraints are there, because that is a great things which are going on in discussion in political circles, that there are regulatory constraints when securing, capital from international sources. Now, many times it has been seen that some hawala kind of transactions they have happened, or some money laundering, or some, what we call the from unidentified sources. They are the money is coming, and in the name of social business, many other. I will not go into the detail of that because of paucity of time. But there is also still regulatory requirement. If we talk of the donations, or as because a funding requirement, donations, or charitable sources, most of the money, if you see, whichever is coming in India, 90% of the funds, they are coming from European countries, or from North American countries, and primarily for charity, or in the name of charity and donations. Because what I personally believe, on the basis of the data and information which I can draw from the existing sources, is that they may be very professional in terms of in the application of the funds which they are giving, but they are also very emotional. They attach sentiments with the societal norms. If people are poor, if people are they don't have the sanitation facilities, or if the people, they are illiterate, they don't have the health services, they are unskilled, so they attach sentiments to that, and they start giving so much of funds in that. But recently, a lot of strict regulatory norms have been set because of the usage of those funds which they have received. And then securing of working capital, and working capital is also a great challenge for these social enterprises. So if you see, these issues are very pertinent if you talk of from the macroeconomic perspective, that these social enterprises are facing. Because if you now we will come down to a little bit on microeconomic perspective, micro financial perspective, like the three important financial issues. First one is financing, then investment, and then what we call earnings. So let us talk something about financing perspective or investment. Now, the difference I have already explained about financing and financial and investment. Now, this is the investment which creates difference between an NGO and a social enterprise. Investment means the investors are going to get the return, and if return has not to be generated, then it cannot be treated as the social enterprise. So return has to be there, and if return has to be there, then this is a social enterprise. So what are the benchmarks? What are the applications which we should refer for the purpose of getting or calculating all these things? So for that purpose, I have prepared a PowerPoint slide which I will like to share with you all. So I am sharing it. So far, any question? I will take up questions in the last. So this is from the perspective of social enterprise and a normal enterprise both. That when we talk of investment or the money, what gives money its time value? The first thing. Then second one is when we talk of calculating present and future values, then how do we calculate present and future values? And then the use of present value technique in the financial decisions. Then introduce the concept of internal rate of return. Normally, what happens that when we compare any investment decision, or when we take any investment decision on the basis of the return which we are going to have in future, we use investment appraisal techniques. Now, those investment appraisal techniques are based on on very scientific calculation. We take it as the discounted cash flow technique. Discounted cash flow technique is nothing but we follow one very important concept in financial management, that is time value of money. With the passage of time, the value of money goes down. That is, $1 of today will not be equal to $1 of tomorrow. So the money which is going to be invested in a social enterprise, it has to be prudently used. You cannot lose your money and be sustainable, follow a sustainable business, because if that is going to happen, then most of the businesses, they are going to fail. अगर हम प्रॉफिट नहीं कमाएंगे, प्रॉफिट अगर हमें नहीं होगा, हम अगर अपने इन्वेस्टर्स को रिटर्न नहीं देंगे, तो फिर वो आगे कैसे उस पैसे को यूज करेंगे? आप तो उनको वहीं किल कर देंगे. वी आर गोइंग टू किल देम. सो दैट मेक्स द डिफरेंस बिटवीन अ सोशल एंटरप्राइज एंड एन एनजीओ. That NGO may not return the money to the investors because that is one-time affair, but here we are talking of social business, so profit has to be there. And if profit has to be there, then normal business, the fundamentals, they have to be followed. Like when we are going to select an investment option, like if I have raised 1 crore rupees for the purpose of funding of any special societal activity, it must get some return. Because if it is not going to be returned, it's simply a charity or donation or a grant. So if it has to be returned, then what particular parameter I am going to follow? So there are certain issues in that. Like one issue is, if I am receiving 1 crore rupees today, then I have to calculate the value of this one in the future. So what compounding rate I am going to use? Compounding rate can be the market rate of interest, or something like return on investment of the amount being invested by the company earlier. And then we can also talk of the discounting rate. When we are going to, when we receive some amount in future, let's suppose after 1 year we are receiving 10 lakh rupees, so what is its present value in terms of today's? So because our decision, it falls largely on in terms of present conditions. So if present condition is permitting on the basis of present cash flows, we need cash flow inflow and outflow. So the cash outflow, it has to be less than inflow in present context. And for that purpose, we use the discounting rate. Discounting rate is the cost, like cost of capital. Like when we talk of take a very simple example of debt, a loan which we take from a bank. Now, what is its cost? So when we talk of a cost, cost is not only the interest which we are required to pay on the loan. Like if the bank is carrying a cost of 10, it carries interest rate of 10%. So 10% is not only going to be the cost. It will be less than 10%, because if I am paying interest of 10%, then I am also saving my taxes. So if tax rate is 50%, so I have saved 50% of 10%. So that needs to be directed from my cash outflow, and then I will be calculating that. And how I am going to calculate if my loan is for coming 20 years or 10 years? I will, there will be a fixed amount of annual cash outflow. So I will be discounting those cash outflows into present terms by using some discounting rate. So that gives us the exact cost of particular source of financing. So our return, it has to be mapped, it has to be matched with the respective cost, and that is how we are going to create value in the business. Because value of a business means value of debt and value of the owner's contribution in the business. If it is a private limited company, there can be 200 owners. If it is a partnership company, there can be 20 owners. If it is a partnership firm, and if it is a public limited company, there can be lakhs of owners. So ultimately, owners will be satisfied, owners will be reinvesting in the business only then there is appreciation of their capital or investment amount, and value is generated in the business. Value means here it is intrinsic value, not extrinsic value, not what we get in the stock market. Every day our stock market is going up by 10,000, 400, 500, 300 points, and the economy is going down. Okay, for last 2-3 months it is going up, but largely the picture is not very enthusiastic. So that is not intrinsic value. Intrinsic value has to be considered here. So when we talk of financing issues, so we must understand the capital. and that is the discounted cash flow, the time preference of money, which I explained it later on. That the risk towards the money or preference for consumption or investment opportunities. Then we also understand that required rate of return, we must add some risk premium. When we talk, or when we have taken amount from some like co-owners, like I am calling them as, in professional world we call them as equity shareholders. In social enterprise we can call them as co-owners. They also need return, because they are the owners. In fact, in that's why LLP mode of business is nowadays so much of successful, that because of its unique distinction of getting benefit from of a PLC as well as partnership firm. So that is why LLP kind of benefit structure is becoming more and more popular nowadays. So when we talk of this ownership structure in the business, the equity shareholders, they may want more return. They may want more return because they take more risk, and in case of debt holders, the risk perception is little bit less, because and if risk perception is little bit less, then we all know that the return will also be less. Then so we need to adjust our cash flows in terms of compounding and discounting. Compounding means when we have to calculate the future value, and discounting means when we need to calculate the present values. So what discounting factor we should use? Compounding, I have already explained that market rate of interest can be used for calculating the compounding interest rate. But for discounting, we can use this one, the cost of capital, as I explained in case of equity. In case of equity, what happens when we talk of the outflow? Outflow is not fixed. The owners which are there in the business, they don't know how much amount they are going to get, and also the enterprise, it also don't know how much profit it is going to earn, and how much amount, whether the amount will be fixed or variable. So various approaches are followed. One such is capital asset pricing model, where we perceive risk as the proxy of the return. When we talk of any particular share or an equity, there is a risk associated with that, because the risk is that if profit is not generated, then return will not be distributed to equity shareholder. So we assume that there will be a return for coming infinite years, because the persons who invest in a company through equity shareholder, through equities, they become owner. And we know there is a unique beauty of a company form of doing business, is that it is separate from its owners. So it is a non-living being entity. So it is having infinite life. So it can continue till the eternity. So in that case, we calculate the cost of equity. So ultimately, adding up all the cost of debt, cost of equity, we get the weighted average cost of capital. So weighted average cost of capital is used for calculating the discounting rate, and discounting rate is used for calculating the present value of future cash flows. Now, whenever we talk of any cash flows, whenever we talk, like you take any business model, like there was that Ligjat Papad or some kind of taxi services, we can all now there has to be some cash flows, and if cash flows are there for future, we need to discount them into present terms. And the basis of discounting is the cost of capital, which I explained. And once you have discounted them, then you convert them into compare them with some what we call the initial cash outflow. And if it is coming out positive, then of course that venture should be done. And if it also helps us in taking a decision like make or buy. Like if I am buying a product from some outside supplier, I'm outsourcing it. So is it good, or should I manufacture it? And if I'm manufacturing it, how much investment I have to do, and after that, how much cash flows will be generated? And comparing that into present terms, will that be positive? And if that is positive, then why not I'm making that product rather than I am outsourcing it from some outside vendor. So it's better I should manufacture it. So make or buy decision also gets sorted out by this kind of discounted cash flow analysis. So now let us come down to this one. Future value, as I explained, future value is calculated on the basis of compounding. Many times, people say, I don't want to depart my money because how much return I am going to get. So for that purpose, compounding formula is used. Simple is also used, and this is how we calculate future value. I think you all will be there to understand. Now another the issue is there, which is of a limit of a fixed amount of investment, which gives me fixed return. So sinking fund is created for that, which is created out of fixed payments. That is, if many times we own an asset, we own an asset in our enterprise which we need to replace after certain number of years, or we have borrowed some amount from the market and we need to repay that amount. So for that purpose, sinking fund is created, where every year from my profit, from my earnings, that amount, that fixed amount gets invested, and for coming, fixed number of years, like 10 years, at a fixed rate of interest, so that after that number of years, I get the desired amount of money. So that helped me to either replace the old machine, or that helps me to fulfill my objective, that particular objective. That particular objective may be to return the loan EMIs. Like many times we take a loan from a bank, and loan is based on reducing balance method. So we need to amortize our loans. That is principal and interest amount. So principal amount plus the interest amount on the reduced balance, and then we calculate the equal monthly installment on the basis of that EMI, which we call. So that EMI is also based on this principles, that is sinking fund principle, that is amortization of loans. So sinking fund is also created for the purpose of meeting our specific requirements. Then these are the present value, and this one capital recovery. This is that. Then net present value, as I discussed. Now many times, what happens, some projects may have net present value, but on the basis of only net present value, we cannot take our final decision, because how much sales we are going to have, or how much what we call it as the break-even point, what should be our cost structure. Then the financial structure of the business is not clear, or capital structure of the business is not clear. When we talk of that, the many times the business entity, they are perplexed that what should be the optimal debt equity combination, means how much amount I should invest and how much amount we should borrow from the market. Now if you do analysis of most of the blue chip companies of India, most of the companies are almost zero debt, or they are near to zero debt company. They have not taken further loans, and in fact, for even small entrepreneurs, if you analyze the amount of loan which is being granted to them from commercial banking sector, that is money market sector, that is also having a declining trend, and NPAs are increasing. Now what are the possible interpretations of this? The one interpretation is that the economic activities are not moving ahead. That's why loan amount is not being disbursed by commercial banks. And even if loan amount is disbursed, the amount is being so invested that companies are not able to get the return, and it means they are not able to repay the loan amount. So there is a very balanced kind of thing between debt and equity, how much balance we need to maintain them. Normally people say that we need to have this balance of what we call 2:1. 2 should be debt, 1 should be equity. Like if we also involve lenders in our business, we also share our risk of doing business. If we involve lenders in our business, and if we are doing all our business on our own money, so if business is going to fail, then it will be only us who is going to lose. But if we are going to involve lenders in the business, then they are not only sharing our capital, but they are also sharing our responsibilities in the business. They come up with not only capital, they also come up with all technological know-how, with all financial know-how. They help us in every matter, so that, because no bank wants its money to get depleted, or to not to be recovered, or it turns bad. Every bank wants that the money should get returned. So it makes excuse me, it makes all effort to get its money back from the investors. So that is the what we call ratio, proper ratio between this. And also one very important thing here is that the cost volume profit analysis, cost volume profit analysis, that we, in other words, we call it as break even analysis, that what should be our sales at which we are going to break even, or our total, we are going to recover our total cost. What happens if we are doing a business where the fixed cost is high? So we also term it as, with help of this leverage analysis, leverage, operating leverage, the cost structure of the business, the fixed cost and variable cost component in the business. If our sales is going to be high, if we forecast, because normally when we do a social enterprise model of business, it is very important to go for some kind of survey where we understand the demand of the customers. And when we understand the demand of the customers, we also do some kind of demand forecasting. And when we do demand forecasting, we also understand that how much sale we can do in the market. And if we are going to do that at higher level of sales, what should be our cost model? Cost model means the fixed cost component and variable cost component. Fixed cost component is sunk cost, means once we have incurred that, we are not going to recover whether we do business or not. It is going to be sold as scrap if we are not going to do the business. So that is fixed cost. And variable cost, it varies with the quantum of production. If we are making the product, if we are selling it, then the variable cost will be there. So cost structure, like if I take an example in front of you, that if this is a mobile, I'm having this mobile now. This mobile, it may have two cost component: variable cost and fixed cost. So let's suppose if the company is going to sell this mobile at a price of 1,000 units per month. Now, what the option is that the total cost of this mobile is 1,000 rupees. Out of 1,000, 800 can be fixed cost and 200 can be variable cost. 800 can be fixed cost. Now, 8:2 is the ratio between fixed cost and variable cost. Now, the reason for this is that it may be possible that company is doing the business through ultra modern machinery. Ultra modern machine has been installed, so a lot of investment is being done on what we call a fixed cost. The another option is that with the same mobile, 1,000 units of mobile is being sold. My total cost is same 1,000 units, but my fixed cost is only 200 rupees and 800 rupees the variable cost. Why here fixed cost is 200? Because the company is using obsolete machine, the company is using second-hand machines, and that is why it is natural that if I'm using second-hand machine, my variable cost will be more. My variable cost, my maintenance cost will be more. So if my variable cost is more, that is 2:8 and 8:2, two proportions can be there. So every aspect is having two contexts. So two contexts here is that my fixed cost and this one variable cost ratio. So that also needs to be decided. What will be my cost structure? कितना fixed cost होगा, कितना variable cost होगा? जैसे मैं अगर एक स्कूल चलाना जा रहा हूँ, तो स्कूल चलाने के लिए हमें सबसे पहले क्या, when we are purchasing transportation, when we are purchasing buses for transportation, so should we purchase first hand buses or second hand buses? So if at a very lower level of economies of scale, it is advisable that you purchase second hand buses, because new bus may cost 20-25 lakhs, but in 20 lakh rupees you can purchase 4-5 buses, 3-4 buses. So initially when and after a certain period of time, when you will start getting the scale, that is the numbers, then you can switch over and you can get your what we call, you can start investing more on fixed assets rather than variable costs. So initially when we do our business, whether a social enterprise or a non-social enterprise or an NGO, it is advisable that the fixed cost component should be less, because if by chance, unfortunately, our sale is not going to increase, then there will be a problem, and we call it as marginal costing problem. What happens that is also used in pricing of a commodity or an item. Let's suppose just to take example of the same. Now this time I am taking example of a pencil rather than a mobile. That is not very handy. let us take this pencil. Now, if this pencil is there, I'm having an option, or I have to take one more thing. Let us take another pen, this pen and pencil. Let's suppose the price of these two writing instrument is same, 10 and 10. This is the selling price, and also the cost price. So no profit, no loss. This is break even. So if the price of this pencil, it is rupees 2 variable cost, rupees 2 per pencil variable cost, and for this pen the variable cost is rupees 8. That is just opposite. This pen is causing rupees 8 variable cost, and this pencil is causing rupees 2 variable cost. Now what happens at lower level of sales? Now the objective of any firm is to recover its direct expenses first. That is the variable cost. If I'm not able to recover my variable cost, then I will not be able to do my business. That is how come I will be making payment to my laborers? How come I will be maybe making payment to for raw materials? So that will be quite very cumbersome. So the objective of any firm, or as per the standards also, the variable cost has to be recovered first, and then the remaining amount which has to be recovered is fixed cost, and we call it as contribution. So contribution means the amount which goes in the recovery of fixed cost, that is sales minus variable cost. Sales minus variable cost is contribution, which goes towards the recovery of fixed cost. So whatever my fixed cost is, even if I am able to recover 1 paisa on it for every unit of sale, that is recovered, and that amount is not going to change. The total fixed cost amount is not going to change whatsoever my sale is. Even if I am selling only 0 commodity, my fixed cost will remain same, or if I am selling 1 crore units, my fixed cost will remain same. So if my gradually sales is growing up, then it might be possible that I may recover my sales with help of every single penny which is being contributed towards recovery of fixed cost. So here I gave example of this pencil and pen, that if this pencil is having rupees 2 of variable cost and this pen is having rupees 8 as variable cost. Now, what will be the minimum price which we can set forth of these two particular items? So if of this pencil, the minimum price can be rupees 3, and of this pen it cannot be less than rupees 9. And and we suppose that both are writing instrument of same quality, same output, everything. They are not pen and pencil, they are both pen. This is analogy. So what happens that after this low variable cost pen will be more competitive and more sustainable in the market. Why? Because what happens, our objective is to recover only variable cost, and if variable, and even after that ₹1 is also left for recovery of fixed cost. तो अगर मैंने ₹1 का क्या कहते हैं वेरिएबल कॉस्ट रिकवर कर लिया, इसमें से अगर ₹1 भी मैंने वेरिएबल फिक्स कॉस्ट रिकवर कर लिया, तो मेरा तो फिक्स कॉस्ट रिकवर होना चालू हो गया. और once I have recovered all my fixed costs, then there is nothing to recover. It is only the variable cost. And we have earlier assumed that the price of this pen is rupees 10. तो इसका मतलब है if once I have recovered the variable cost, जो कि इसका ₹2 है, तो ₹8 तो मेरा प्रॉफिट हो गया. 80% मेरा प्रॉफिट हो गया. 80% मेरा प्रॉफिट हो गया. अब क्या है कि अगर मैं एक बार मैंने ब्रेक इवन पॉइंट अचीव कर लिया, यानी कि मैंने टोटल कॉस्ट रिकवर कर लिया, यानी फिक्स कॉस्ट रिकवर कर लिया, तो हर पैसा, हर रुपया हर पेन जो मैं which I am going to sell in the market, it will give me return of 8 rupees. 8 rupees. And now see what happens to this pen. Now this pen, the variable cost is rupees 8. Now I have to sell it at a minimum price of rupees 9 because I cannot go below. So here, if this pen is also causing the same output, अब मैं इसको ₹3 में बेच रहा हूँ, इसको ₹9 में, so of course this pen will kick it out. This pen will kick it out from the market, this pen, and this will be thrown out of the market, and ultimately this pen will survive. So because the variable cost, the pricing of this pen is rupees 3, and with the same quality at lower price, the market is operating in a razor thin margin where the dealers are operating on only discounts. What to talk of the difference in the prices? Most of the products they are offered at the same price, same quality, everything is same. So it is cutthroat market. So it is not possible for this company to survive with the variable cost of rupees 8. So, but still, let us assume that the variable cost is rupees 8, and still it is able to sell its pen at rupees 10. Now, what happens? This the it will able to achieve its break even point earlier in comparison to this pencil. ये जल्दी अचीव करेगा this pen, इस पेन के मुकाबले इसका वेरिएबल कॉस्ट ज्यादा है, but its fixed cost is less. So the product for which the fixed cost is less, it will be able to achieve its variable the total cost earlier than in comparison to a pen whose variable cost is less, because there the fixed cost is more, and it will take more pens to sell to recover your variable cost. So fixed cost. So what happens here? The break-even point will be achieved earlier, but after that, what happens? For every pen which is being sold at the price of rupees 10, the profit will be only rupees 2, because 8 rupees the variable cost. So here the profit is rupees 2, and here the profit is rupees 8. So 4 times is the profit of this pencil in comparison to this this pen. So this is what we call leverage, operating leverage. Operating leverage. Now this happens because of fixation of our cost structure. Cost structure means हमें fixed cost कितना रखना है, variable cost कितना रखना है. This is in our hand. If we are installing our, if we are doing our business with ultra modern machines, or we have purchased a new piece of land altogether, एकदम नई जमीन खरीद ली शहर में, what will happen? Your fixed cost will go up. If your fixed cost goes up, then you will be able to you will, in short run, there is a problem. If your sale does not picks up, then you are caught in a trap. You are caught in a trap. If your sales does not pick up, then you are caught in a trap and you have to shut your business. But if your sales gets picked up, your sales start growing up, if your sales start growing up, then there will be a lot of problem. So if your sales starts growing up, increasing, then you will be the king of the market, because you have already recovered your fixed costs. Only variable cost has to recover. Then no one can beat you in the market. You are social enterprise. You are not a normal enterprise. No other, no one can beat you. No one can defeat you in the business. So this is what we call operating leverage. Operating leverage, leverage means, something which we get more in terms of the resource what we put in. So one time Archimedes has said, if I am given proper fulcrum, proper base, proper rod, and so I can even lift the earth. What he tends to say that with a minimal effort, how I can magnify our profit. So you take example of this pen and these 2 pens. Now what happens that we have not changed the total cost is same. Total cost is same. The total selling price is same. But once the break-even point is achieved, this pencil is outperforming this pen in every sphere of the performance. Its profit is magnified by 4 times. Its profit is 8 rupees. Its profit is only rupees 2, because of the difference in the variable cost. And this happens when we used to think, when we visualize the thing, when we have a vision, then what happens? We set our cost structure accordingly. So cost structure has to be set very prudently, so that in the short run, you are not crippled with the excess of fixed cost, because if sales does not picks up, then you are in a fire. Now what will happen? It's a double-edged sword. It operates both ways. It kills your competitors. It can also harm you. Like it comes on your face also. So it's like double-edged sword. So leverage, it operates both ways. It can be a negative leverage. There can be a positive leverage. So, and the earlier leverage which we talked of, that was financial leverage. That is debt and equity, debt and owner. That is the borrowed amount and your own amount. Own amount is equity and borrowed amount is the debt. So the proportion between that. So that is also a leverage. What happens if we see that if we borrow more and more from the market, then it might be possible that our interest that we might have more tax advantage in terms of interest deductibility, tax deductibility of the interest. But what happens? You go on borrowing more and more. I'm saving taxes. So you go on decreasing your share. You go on increasing the share of borrowed amount. Then what happens? That after some time, that you have borrowed to an extent that after some time you are not able to repay the interest. And if you don't repay the interest, then what happens? Your company goes bad. And if company goes bad, then after some time it becomes sick. And if it becomes sick, then it cannot repay its loan. Then its management has to change. Now the company can be referred to BIFR, Board of Industrial and Financial Restructuring. So the company can be referred to some other agency, and it can be sold. Or even the management can be changed by the formation of asset reconstruction companies. So these are the issues which we must understand at a time of financing. Financing means what should be our capital structure and cost structure, and it gives us financial leverage and operating leverage. Both things, financial leverage and operating leverage. And if we multiply them, we get combined leverage. So these issues are very, very important when we decide on financing activities. Financing means the deciding on at the firm level what should be our debt, what should be our equity, and what should be our cost structure. Now instruments we have already discussed. The instruments for working capital, for for long-term funds. For working capital, for that various sources are there which the firm can borrow from the money market, and for long term the firm can borrow it from the capital market in the form of equities, or in the form of what we call debt or debentures or bonds. Here I can suggest two kinds of instruments are there for social enterprises. One is the social bond, other one is the social equity. Now just like in foreign countries, we have registered stock and bearer stock. Registered stock is that stock which gets registered in the books of the company. If I am the owner of the registered stock, what happens? I can vote in the company. I can control the company. I am a registered stockholder, and I can get the dividend. So through registered stock, I can vote the company. My name is registered with the company. I am the owner of the company. And bearer stock is that stock where the owner of the bearer stock is not eligible to vote. It cannot control the company, but it can get the dividend. Similarly, why not we can have social equity kind of thing, or social equity fund kind of thing here in India. Just like social venture capitalists are there, we should also have some kind of small scale. Just like earlier we were having OCTEI. Now we should also have some kind of some social equity index, which we don't have at present. And for that purpose, government should take initiative to motivate the investors to put in their money in the equity, and some kind of social equities can be issued and get listed, because the listing fees in the normal stock exchanges like Bombay Stock Exchange and National Stock Exchanges, it is not possible for small entrepreneurs to go and register themselves. So earlier there was OCTEI, but that has now been abandoned. So there has to be some initiative so that the social equities can be issued in the market in the cap, and there is plethora of instruments existing in the capital market. There is quantum volume of funds are traded in the capital market. So why not the social entrepreneurs, the social enterprises, they can have their pie from the market. So the government can set up some social equity index or social equity trading market in our country, where social enterprises, they can go and issue equities there, and now the return to the investor. Because if market can be established, but ultimately it is the investors who have to participate in the market. So for that purpose, because this, just like I explained the difference between registered and bearer, similarly the social equity and normal equity can be there. Social equity may not carry dividend, but it can have the appreciation of the capital, and normal equity, of course, it carries some dividend on it. But nowadays, see, there is no significance of the dividend, because dividend is paid on par value of the share, and par value of the shares, they are rock bottom. It also happens to be rupee 1. Just take an example of TCS shares. Now TCS is a company whose par value of share is rupee 1, and and the share is trading exactly, I don't know, but somewhere around 1,500, 2,000 rupees. So even if the company announces dividend and if you purchase a share of rupees 2,000 today, and if company decides to give you a dividend of rupees 100% means on an investment of 2,000 you get dividend of only rupees 2. So it is insignificant. Even if company decides to distribute dividend of 1000%, you get only rupees 10 on investment of 2000 rupees in a year. So that is insignificant. So normally investors, they don't invest in the equities unless and until it is an IPO or it is from the control perspective. They don't invest from the perspective of dividend. They, unless and until they don't have the control perspective, their sole perspective is to get capital appreciation. Capital appreciation has to be there. So why not to encash that sentiment? The some kind of, either it can be a private initiative also, to start with some Ministry of the Small Scale Industries, it can MSME, or it can establish that index where small enterprises, they can come and they can index those shares. And even those who want to give grants or charities or donations, they can list their shares there. They can participate as an investor there. Yeah, of course, it is not technically correct to call them investor, because they are one-time giver, they are one-time contributor. But that has to be reflected somewhere, and that gives some kind of intra company competitiveness. So social equity should be there, where investors, they are not receiving any kind of dividend, but the appreciation in the capital price can be there. Those who can purchase shares, they can come in the market, they can purchase share, and the investor can gain out of it. So social equity. Then similarly, in on the social equity front, there can be sovereign social bonds. So sovereign social bonds means the government should allow the Indian enterprises, social business enterprises, to issue bonds in foreign countries. Just like we have foreign companies coming down to India and investing bonds in India in any currency like dollar or Indian currency. Similarly, the Indian social enterprises, they should be allowed to raise funds through sovereign social bonds. Now they can go, and why I'm saying this foreign countries, because there is a great potentiality and of getting funds from abroad. When the government is having strict regulatory norms in terms of getting foreign funding from outside, now that is one-time transfer. Why you are making one-time transfer? Let it be two-way. You receive the funds in the name of sovereign bonds, and let the foreign investor gets half of the return what other players in the market are getting. As I said, social bonds, they will be having return, but half the rate of interest at what other players are getting, because there has to be some subsidy, because the net amount of profit is not meant for here. The objective of profit is not here to earn profit. Social enterprises, it is for the societal objective. तो कहने का मतलब ये है कि अगर बॉन्ड इशू कर दिया फॉरेन कंट्री में, तो हाथों हाथ बिकेगा भी, क्योंकि उनके फिलैंथ्रोपिस्ट बहुत ज्यादा होते हैं, इमोशनल सेंटिमेंट्स बहुत जुड़े रहते हैं, और ऐसे देशों से तो वो ऐसे कामों से see in African countries how much they are investing, in Asian countries how much they are investing through WHO or through IMF or whatever it is. So allow Indian small companies to under the strict regulatory norms, allow them to issue bonds in a foreign country at a subsidized rate. Let foreigners, they purchase those bonds, they pay amount, let these social enterprises bring money in Indian economy. Ultimately, this will increase the foreign exchange reserves of the country as well, and this will also enhance the liquidity base of the companies. And ultimately, this will be part of more formalization of the funding pattern of these social business sector. And ultimately, what will happen? That they will be formally associated with capital market. So social bond, that is sovereign social bond, and so of course social bonds are there. Social bonds means the bond should be issued in the domestic market, where if I'm the investor, Now of course, for that a specific a different credit rating agencies are there. Now at present, for rating of normal bond issues, there are 4 different credit rating agencies. ICRA is there, IC, then there are 4 different SCRA is there. So 4 different credit rating agencies are there, which can, and for the purpose of credit rating of the bonds. Now for social businesses, there is total absence of this. If a company wants to get its bond issued, you cannot give credit rating to a social business and a normal business on same parameters. You need to design parameters for social businesses, for social enterprises, different set of parameters, and those parameters will be, should have to be, how, to what extent they are able to fulfill their social objectives. It is not the profit only. Profit is there, यानी हम प्रॉफिट करके सोसाइटल काम कर रहे हैं या सोसाइटल काम करके प्रॉफिट अर्न कर रहे हैं. तो यही डिफरेंस होता है सोशल एंटरप्राइज और एक नॉर्मल एंटरप्राइज, सीएसआर में और सोशल एंटरप्राइज में. तो अब the rating agencies cannot have same parameter for giving ratings to social enterprise and a normal enterprise. These normal enterprises, they must have stringent parameters of rating, but for not social enterprises, mutual rating should be there, peer rating should be there, so that the investors, the potential investors, they can evaluate different options of investment, and they can give their amount, and so that the more the funding could be more transparent, more structured, and the financing activity can be more formalized, and the social enterprises can be annexed with capital market or money market institutions in a more deeper way, in a more deeper context, because the government is having a lot of inhibitions, that the putting a lot of regulations on the funding issues related to these social enterprises. In this way, the transparency can also be ensured. So we must understand that these norms should be followed, so that the financing issues can be solved. Now let us come down to, once financing issues are resolved, then comes the investment. So on investment front, we have already discussed that the return should not be less than cost of capital. The return should not be less than cost of capital means we must understand the importance of rate of return, the internal rate of return. A project might have multiple rate of returns also, but here I am taking it as one rate of return, internal rate of return. So the net present value, what the project is having, it has to be positive. We must understand the importance and significance of the positive present value of a project option. It should not be discounted in the name of social business. It has to be self-sustainable business, self-sustainable business, because if profit is not being generated, and even if subsidized return is not being given to the bondholder or shareholder, how come it can be multiplied? How come it can be transmitted to other needy enterprises in the economy? So that is why we must understand the importance of this return to them. And then comes the issue of the earnings. Earnings is the difference between financing and then investment. So financing has to be prudently decided. The sources has to be prudently decided, and then the investment is there. Investment from different perspective has to be evaluated. There can be thousands of investment options. For that purpose, evaluation, some simulative exercises can be done, some sensitivity analysis can be done, so that a possible investment option could be selected, so that keeping into consideration our broader vision of societal objective, fulfillment of societal objective, the profit could be generated. And then comes the earnings, which we have talked a little bit, that earnings should be distribute part of the profit to the social equity holder or not. And second one, to what extent interest should be distributed to the coupon rate interest, we call on the bondholder as coupon rate. Coupon should be given to the bondholder. On that front, there can be a reason that if profit has to be retained back, or in the name of reserves, or for the purpose of reinvestment, then opportunity cost must be analyzed. Opportunity cost must be analyzed means what? Like if I am the lender, if I have paid 10%, if I have given loan to the social enterprise and I am getting return of 10%, I am getting return of 10%. And if the social enterprise is getting return of 20% or 11% or 15%, then I must not demand return from the company. I must not demand return from the company, because as long as it is able to get more return than what I am demanding or I am forcing, then I should not demand return from the company. So ROI, that is rate of return on investment, must be the benchmark for distribution of earnings to the investor, whether it is equity holder or it is debt holder. So both has to be there. That is rate of return and as well as the expectation of the investor. So invest from the, this could be the benchmark rate, if the expectation of the investor and expectation should be, known to the firm exclusively through the signed agreement, that this is this for coming 3 years, 4 years, this is our expectation for which we are providing funds to the company. And as long as company is earning more return than the expected return, then company is not going to give the return to the investor. And whatsoever the duration of the investment is, whether it is some kind of redeemable commitment or non-redeemable commitment. Now the duration of after once that gets expired, now some incentive has to be given to the investor, because principal amount is returned back, but the investor cannot treat this company at par, the social enterprise at par with the normal enterprise. So, but we have to also incentivize the investor. The social enterprise has to incentivize the investor for these long, so many years. It has not demanded return. So principal has to be accompanied by some return which the company has earned year on year. So that is to the extent of lender, that is the bond holder. Now in case of equity holder, as I said earlier also, that they must participate, even if they are not getting dividend, no equity shareholder, either you take the charity, you take the donation, you take the grant, one-sided fund, no problem. Many companies are there, they have established, even now there was a news yesterday that government has allowed corporations to set their own commercial banking arms, own financial institutions. So its impact is yet to see, but this is not correct that this is a new phenomenon in the world. Now this was already there for last so many years in Japanese financial market. Now government is trying to copy it from Indian context, because these industrialists, they are becoming more and more defaulters to its own commercial banks. So let us ask them to open their own banks and let them default from their bank. So the government has just decided that. So the thing is that if you are not going to incentivize the social equity holders, no one is going to give you their money in the name of investment. Investment, if you want investment, if social enterprise wants investment, in that case, this kind of instrument has to be there. That social equities, the social equity holder, they must have the voting rights. They must have the right to share the capital appreciation, and in fact, dividend may not be given. Dividend may not, because if dividend is to be given by social enterprise to the equity shareholder, then there will be not much difference between debt holder and the equity holder, as well as social enterprise and any other enterprise. So as far as the earnings are concerned, and timing of earnings is also when the earning is going to be distributed. When we talk of these social enterprises, we cannot weigh them on the same parameter as normal enterprises. Like in normal enterprises, what happens if economy is booming, distribute dividend. If economy is not booming, don't distribute dividend. And if depression is there, follow this policy. If recession is there, follow that policy. So that should not be there in case of social enterprises. When we talk of timing or distribution of earnings or retention of the earning, so retention has to be the reinvestment of the profit has to be incentivized by the government. When in what form? Let me give you one example. Like if a machine has to be installed with a reinvested profit, now this profit earlier belongs to equity shareholder, but company has not distributed dividend, because this is a social enterprise, so it cannot distribute dividend. So why not? The government is offering some kind of GST cut or tax cut on the amount being spent of this stature on the purchase of any capital item. So this kind of incentive has to be given on the purchase by reinvested amount, so that the companies they can have some lucrative motivation for retention of the profit, not distributing it, because social enterprises, there is a limit. When we talk of reinvestment kahan karenge? The business expanding karega. If the large corporates, they are not approaching banks for getting funds. So government is only having one option: don't approach us. You open a bank on your own. You open a bank. So similarly, if social enterprises, it is difficult for them to expand. It is so what they will be doing for on the reinvested amount. So it means they will be either sitting on huge sums of reserves or on some huge sums of reinvested amount. So, but outcome will not be there. So if outcome will not be there, then self-sustainability will get suffered. So that is the most important thing nowadays: self-sustainability of any enterprise that is social enterprise. It makes difference. It creates difference from normal enterprise. So that is why when we talk of social enterprise, it does not mean that it is not going to earn profit. Proper profit has to be there, but it has to be self-sustainable. अगर equity shareholder का पैसा हम नहीं वापस करेंगे, ठीक है, but it has to get appreciated. If it is not getting appreciated, the equity shareholder, the social equity shareholder, will not get the return. Similarly, the social bond holder, if it is not going to get the interest back, even the subsidized interest, how come that amount, if it is going to be eaten away by the existing enterprise, then how other enterprises will they will be getting? You आज की डेट में क्या हो रहा है भाई? पुराने enterprises, they are getting easy money, but for new enterprises you need now angel investors, but angel investors are not present in case of social enterprises. Sorry to say, it is very difficult to find angel. Normal investors के केस में मुश्किल है, तो social enterprising तो बहुत ही मुश्किल है, क्योंकि सबसे बड़ा जो मैंने आपको अपने उसमें डेलिब्रेशन में बताया, जो एक सबसे बड़ा इशू है, वो है फाइनेंशियल स्ट्रक्चर का, स्ट्रक्चरिंग ऑफ द फाइनेंसेस. फंडिंग तो कहीं ना कहीं से मिल जाती है, बट फंडिंग क्रिएट्स सम काइंड ऑफ हैंडीकैप. भाई हम चैरिटी कर रहे हैं, फॉर दैट आई कैन गेट सम काइंड ऑफ ग्रांट, आई कैन गेट डोनेशन, बट दैट इज वन टाइम, दैट कैन फुलफिल माय फंड रिक्वायरमेंट, बट माय फाइनेंशियल financing requirement cannot be fulfilled. So that is what I have to deliver regarding the financial issues related with social enterprise management. I think my time is also over. Exactly, it is now 15:33. So again, I would like to thank all the participants. There are 98 in number. The numbers were fluctuating from 104 to 98. So altogether now it is 97. So once again, thanks to Dr. Vishal and Dr. Anurag for giving me this opportunity. Thanks a lot.
Thank you so much, sir, for this particular wonderful session. I must say, sir, that all the participants are getting the all-round dimensions of the knowledge for the social enterprise management. Talking so, like yesterday's session was being taken by Professor Ashish Bajpai, sir, and he elaborated on the how basic thing about the idea generation, decision making, and today's session we have a live experience, a practical experience of entrepreneur. And in today's session, very important topic you have covered about like idea generation. Things are the basic thing, but the very basic requirement of running an entrepreneur or startup is the getting the fund from the different sources. So you have highlighted on the various issues an entrepreneur faces while raising the fund, and you have rightly concluded with the points, sir, like raising a fund and maintaining the finances are the two different parts. Like you can manage a charity for one time, but at the same time, for the long term of the business, you have to look into some good financial sources. So overall, this particular session, the participant must be able to know that what are the different problems an entrepreneur faces with respect to the accumulation of the finances, the fund. And in the coming session, sir, I'd like to inform you also, like tomorrow session, we will be covering about the marketing concept. And so overall, the participants are getting the 360-degree approach regarding the social entrepreneurship. And with this particular thing, sir, I would like to invite participants for any kind of query, any kind of questions. Do you have? You can.
Vishal, Dr. Vishal, was one question: is there can't a social enterprise work as private limited company?
Okay, sir.
So I would like to answer it
Yes.
if time permits. It is already 15:35.
Yes.
Okay, Dr. Amisha Shah. You asked, can't a social enterprise work as private limited company? It can work. It can work. The objective of a private limited company is, to earn profit. It is wealth maximization of shareholder. There is no such formal definition of, social enterprise here. If what I said, if I'm doing business for profit, and after that I'm doing some social charity or some societal kind of thing like CSR activity. So in this way, all firms are social enterprises. No, I am doing my business with social objective in my mind, and in the meantime, I'm earning profit. So that I can do as a, so it is a thing of your policy. So that policy decides what structure you are going to opt. As I said, it can be PLC, it can be a trust, it can be a society, it can be a partnership firm, it can be LLP. It can take any form. It can take, these are the all legal structures of business. A social enterprise is not having defined like this is a social enterprise or this cup is a social enterprise. This अगर ये structure होगा तभी ये social enterprise है. This is not that. Social enterprise कोई भी हो सकता है. Profit business है ये. This is a business. This is business. और business किसी भी structure से किया जा सकता है. Objective आपको set करना है. Policy आपको set करना है. आपकी policy ये है कि आप what do you say, that to earn profit, wealth maximization of shareholders, let us distribute most of the wealth to the shareholder. Yes, then you are a not social enterprise. You are a pure for profit enterprise, for profit enterprise. So social enterprise can be a for profit, can be not for profit enterprise, both. Trust, yes, but as I said, social enterprise self sustainability is also very important. And NGO, if it is self-sustainable, then it's a social enterprise. A company, if it is a self-sustainable, it is a social enterprise. Yes, you have written, yes, they can't distribute dividend to, correct, correct, right. If dividend has to be distributed to equity shareholder, it means you are working on wealth maximization of shareholders. And if dividend is distributed not to shareholders, but for societal causes to fulfill the societal causes like literacy, skill development, or whatsoever it is. Like I am a consultant company, and I am arranging training for all unskilled laborers. And in the meantime, I am earning profit. I am a social enterprise, and this I can do by forming a private limited company also.
Any other query, participant? Okay.
Sir, I have a question.
Yes.
Nivita from Chennai. There is a business model like Keto dot organization, KETO dot organization. It is basically a model. It's an e-commerce platform where it connects between the person who donates, who want to donate, and the donor, like for any cause. It can be for health or it can be for anything. Okay, so that is the platform, e-commerce organization. So in that case, is this a social enterprises? Because the motive is to help the people.
So see, profit has to be there. Profit. May I know your name, please?
Nivita from Chennai, sir.
Okay. Profit has to be there. Social business. Social enterprise means business. Business has to be there. So self sustainability has to be there. Donations, charity, they can be part of the funding of the enterprise, but they cannot help the enterprise to become self sustainable. So to self sustainability, profit, not for wealth maximization of shareholders. These are the three essential attributes of an enterprise to get categorized as social enterprise.
Oh, thank you, sir. Thank you, sir.
Thank you. Welcome.
Now I would like to invite Dr. Amisha Shah to share her experience on the behalf of all the participants regarding this particular session.
Thank you, sir. Good evening, one and all. Respected Professor Amit Gautam, sir, organizers of the program, and dear participants. I'm thankful to you for making me fortunate to share my experience again for this wonderful session. Today, Professor Amit Gautam sir beautifully explained how profit and societal objectives must go hand in hand in case of social enterprises and focused on basics of social enterprise management. Sir explained the importance of being self-sustainable, focusing on funding issues as well as financing and financial issues. By interactive discussion about financing, investing, and return activities, so made this session, even post lunch session, so live, interesting, and thoughtful in real sense. As we know, finance is considered as the lifeblood of any corporate business entity. It is similarly important for social enterprises too. So, capital, cash flow, time, preference for money required, rate of return, combination of fixed and variable cost ratio, present value, rate of return, etc., are very important topics which were discussed deeply and beautifully in this session. So, on behalf of all the participants, I express my gratitude and thanks to Professor Amit Gautam sir, again and again for his extraordinary talk full of enthusiasm and zeal. Further, I'm thankful to Dr. Anurag Singh and Dr. Vishal Lahiri for managing all the sessions with care and concern. And I must appreciate the effort, sincerity, and dedication of organizers for making this whole program fruitful and successful. Thanks once again. Thank you so much.
Thank you, Dr. Amisha Shah. Thank you, sir, for this particular session, sir.
Thank you, Dr. Vishal. You are conducting it very nicely.
Thank you.
All kudos to you and the coordinator of the program.
Thank you, Doctor. Thank you very much.
Thank you. Thank you.
Sparing time.
Thank you, sir. Thank you. Thanks a lot. Now it's over to you, sir. Should I leave?
Yes, yes.